You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In today's industry happenings, we're going to talk about the elimination of stop orders at some of the stock exchanges. The option exchanges still accept stop orders, but not the stock exchanges. Recently, the New York Stock Exchange announced they'd be joining NASDAQ and BATS in no longer accepting stop or GTC orders. Before I go further, let me be sure you know what both of these order types are. A stop order is an order typically placed below or above the current market. It's generally used by investors to get out of a position gone bad at the stop price. Let's look at an example. XYZ stock is trading at $40. We believe the stock is still in a constructive pattern as long as it trades at $37 or above. Below $37, we believe the stock has real downside potential, so we place a sell stop at $37. That means when and if the stock trades at $37, our order is executed as a market order to sell our shares. In very volatile markets, you can't be sure how close to $37 your order will actually trade, so do be aware of that. There is also a stop limit order. If we placed a $37 stop limit order, once the stock trades at $37, our order is then placed on the book to sell the shares at $37, not a market sell order. If the stock keeps falling below $37, we wouldn't get to sell our order at $37. Those shares would remain on the book at that $37 price. That's a quick overview of stop orders. The other order type the exchanges are doing away with are GTCs, good till cancels. Please do check with your broker to see how they are dealing with these order type issues. But let's go back to our $40 stock that has fallen and is now trading at $37. That's the important level based on our research where we may want to initiate an action. Listed options could be just the vehicle to take advantage of, in this case, a bearish opinion on the underlying stock. If we're bearish at 37, in the listed options market, we could consider buying a put, and in the money, at the money, or out of the money. We could also buy a put spread, depending on what strikes are offered. Buy the in the money $40 put and sell the out of the money $35 put. We could also sell a call, but that would have unlimited risk, which all investors have to be very careful of. Far less risky, but still bearish, could be the choice of selling a call spread. Sell the 35 strike and buy the 40 strike, or some other combination of strikes. There are many different choices with options. Keep them in mind, especially when your favorite stocks, ETFs, or indexes trade at important levels in the marketplace. That's a wrap for today's industry happenings.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
In today's Strategy Spotlight, we're pleased to welcome Bill Ryan, Managing Director at New York Stock Exchange Options. Welcome, Bill.
Hey, Joe. How are you?
Doing great. Hope you are, too. I know some of our listeners may know you as an OIC instructor. You know, you do presentations across the country on behalf of OIC. Do a great job. We appreciate that. Now, there may be a few of our listeners who don't know about you, so why don't you tell them about your career in this industry?
Sure thing, Joe. Well, I've been involved in options since 1982 with E.F. Hutton. So I've been around for a while. I've always been on the retail side of this business, dealing with brokers and with individual investors. For the last about 15 years, I've been at an exchange, either at the American Stock Exchange or here at the New York Stock Exchange, but again, focusing on the retail side of the business. So again, dealing with individual investors and brokers.
Well, we're happy to have you today. I think you may know January's OIC education theme is Options 101 as we get the new year started. So what we're interested from you, Bill, is hearing your perspective on how you think our listeners can best begin to learn about options, especially if they're just starting out. What do you think is the best approach?
Well, first, Joe, let me say I think starting at the beginning, like, options basics, ABCs, whatever you want to call it, is a great idea for January. Let's get the new year started off right. And I love teaching the basics to individual investors because that's where they get their ideas. You see the light bulb go off, and people walk out of a room, or after listening to a seminar, they come out and they have an idea about what they can do and make things different. So best place to start, I think, when you want to learn about options is just understand the mechanics first. What's a put? What's a call? What do they do, and how do they do it? And options are relatively simple if you understand the four concepts and the rights and obligations. And it's simply, a long call is the right to buy a call. A long put's the right to sell a long call is the right to buy the stock. A long put's the right to sell the stock. A short call is an obligation to sell a stock, and a short put is an obligation to buy the stock. And if an investor can learn that and understand those four basic rights and obligations, they can go anywhere they want in the options world.
And is there a best way to not get confused when learning that?
Yeah, Joe, when I started the business, the old guy on the trading desk, who was probably in his 40s at the time, told me the best way to remember it is that if you're long a call, you have the right to call the stock away from someone, meaning that you buy it. And if you're short that call, you have the stock called away from you, meaning that you sell it. And if you're long a put, you have the right to put the stock to someone, meaning that you sell it. And if you're short that put, you have the stock put to you, meaning that you buy it. That's how it was explained to me in 1982, and I still remember it to this day. And I think it's a pretty simple explanation. It's pretty easy for people to understand that.
Yeah, I think, I find as we start as educators, it's getting through those first concepts, as you said, those four key ideas. And sometimes, the idea of the put, the call, the buying, the selling, the right and the obligation, it gets confusing, but I think if people stick to it, it tends to stick.
Well, I would say, and with options like a lot of other things, whether it's a golf or it's skiing or whatever it is, it's practice. It's being familiar with it and doing it over and over. And so if you learn those four concepts and you think about the rights and obligations every time you look at an option contract, you'll understand it that much better every time you do it.
So, you mentioned practice, and everybody's probably a little different in terms of their learning capability, but do you have a sense for, whether investors starting out should test or practice options, once a day, once a week? How much time? What's your sense of that?
Well, I think that, first of all, the option market is very dependent on the stock market or the equity market. So I think as an individual investor, once you familiarize yourself with options, if you look at a stock, and let's just say we're bullish on XYZ, and you're going to buy XYZ, well, when you think about buying the stock, well, stop for a second and say, what can I do in the options world here? And if you're reluctant to use options, write it down on a piece of paper. Try your idea out on paper and see how it worked compared to buying the stock. But every time you think of an equity, think of the option equivalent or think of an option strategy that might work for you. And if you do that every time, you'll become more familiar and more comfortable with trading options.
So how about if we go through an example? You've got this stock that you're bullish, on. There are a lot of different options that are out there. Why don't you tell our listeners, give them a couple of choices, the in the money, the out the money, the out of the money, things like that.
All right, so we're bullish on the stock, right? The market's been down lately, and a lot of people saying here's a buying opportunity. So we're going to buy something. We look at this equity that we like, and we think we can buy it. And let's just say it's trading at about $24. So instead of buying the stock for $24, I take a look and I see that we have a 20 strike price call, a 25 strike price call, and a 30 strike price call. So I could either buy the stock for $24, or I can buy the $20 call, which may be trading at least $4, maybe it's trading at $5, because that's in the money by at least $4. The $25 call may be trading around, maybe $3, and the 30 call might be trading at about $1. And I'm just making this up as I go, so those are actually not really accurate, but they're good for an example. So instead of buying stock at 24, you say to yourself, if I buy the 20 call and I pay 5, that's a break even of 25. I need the stock to go up $1. So I don't need to move $1 before I can start making money. The 25, the at the money, I can say, okay, I could buy this for 3, and my break even is 28. That's 25 plus 3. That's 28. Will the stock get to 28? I have to think about that for a second. It's trading at 24. Will it get to 28? And 30, the out of the money, would have a break even of 31. That's the strike price plus the premium of 1. That's 31. Will my $24 stock get to 31 before expiration? You have to think that way. And you look at these 3 ideas, write them down on a piece of paper, and see how they change, see how the prices change as the stock goes up or the stock goes down. So I would look at 3 ideas like that, 3 very basic ideas for buying that call, and I'd compare that to buying the stock and see what happens.
Just to clarify, those different break-even points you spoke to, that would be at expiration. So with the stock at 24, it doesn't necessarily have to go to 31. If we're talking before expiration, that call could still appreciate in value significantly without the stock even getting to that break-even point. Is that right?
Yeah, absolutely. And there's other factors at play here, and we're just looking at the basics right now. If you want to get into discussions of volatility and time, we can get into those discussions, and that's what affects the option price as well. But from a beginner point of view, you want to know what your risk is and what your break-even and your reward is. So the risk is the premium that you pay. The break-even is the strike price plus the premium, and the reward is unlimited above the break-even point until expiration. And that's where the beginner has to start. And then as we get a little more comfortable, then we can look into volatility, we can look into time, we can see what other factors affect our option price and how we can make money if the stock doesn't get to the break-even, and how we can make money before expiration. And that's one of the beautiful things about options. There's a couple of different ways to make money. It's not just cut and dry. Buy it, it goes up, I make money. If I buy it, it goes down, I lose money. There's other things that come into play in the options world.
Indeed, there are. That's what makes it such an exciting, financial space. Actually, in terms of some of those other things you were talking about, delta and volatility, in the months ahead, I know Options Industry Council will have various themes, and a few of those will be, focused on, I know, sometime later this spring. One thing I want to just kind of make sure our listeners are aware of, you talked about, the various choices, buying the stock at 24 or buying the different options. Can you talk about the amount of money required, to purchase those different choices?
Oh, sure. Look, if we buy 100 shares of stock at 24, that costs us $2,400, and our risk is $2,400 because, like it or not, stocks do go to zero. And like I said in the beginning, we're in a market that's been down for the last few days, so stocks do drop. But your risk is everything that you pay for that stock. If I buy the $20 call and I pay $5, that's $500. 5 times 100, which is the underlying of the contract, that's $500 at risk. So the most I can lose there is that $500. So we have a big difference in risk here. Reward side, if you look at the stock, as soon as it goes up $1, I'm making 100. Whereas I have to get through break even. I have to get to 25 to break even on my call. So there's a balancing act in there.
Well, that's good. I think that's an important point for people to realize that there are definitely different levels of capital that are involved between purchasing underlyings versus the options themselves. I'm a new student, learning about options or trying to learn about options. How can I have some confidence that I am making progress? Any sense of that?
Joe, you know better than I do, OIC's My Path is a great place to learn. And on OIC's website, there's a paper trading account, and you can go into the paper trading account and, populate it with, $5,000 and try different strategies and see how they work. It's easier to lose paper money than it is to lose real money. But the fact is, Joe, you don't learn any faster than when you lose your own money. And, I wouldn't advocate anybody putting lots of money into the options market and losing it. If you come into the options market, start small. Make sure you can handle the losses that you may have, understand what that risk is, and learn that way. But I still think you should try it out on paper first, get a sense of what happens to an option, become comfortable, and then try it with real money.
So a combination of picking maybe a favorite underlying that you're have some knowledge of, choosing, different calls at different strikes, and maybe, as we get more advanced, consider potentially a call spread, things like that, to try online. Bill, is that what you're suggesting?
Absolutely. And, Joe, you have a great point, a stock that you're comfortable with. It's a stock that you understand, one that you've been doing some research on, whether it's technical or fundamental, however you pick your stocks. Get comfortable with the stock. If you're comfortable enough to buy the stock, you should think about the options world and be comfortable to do that option trade once you're comfortable with the stock and the idea in your head, and then you go do that options trade. And if you're going to go out and buy 10,000 shares of stock, you don't have to buy the equivalent in the option world. Try one. Buy some stock and buy 1 or 2 calls to see how they work. Don't walk up and dive in head first. Take your time. Kind of wade into the water and make sure you're comfortable with it before you go crazy.
Makes sense. Now, we are talking options 101 here, so. We don't want to get too far down the road, but you had mentioned intrinsic value and time premium. Could you go over those concepts one more time just so people understand, what intrinsic value is and time premium?
Sure. Intrinsic value is the value that the option has right here and right now, and you calculate that by understanding what the rights and obligations are of options. So let's go back to our $24 stock, our 20 call with a price of $5. So the right of the long call is to buy the stock at the strike price, which is 20. So if I'm long that call, I have the right to buy the stock at 20. I would sell it in the open market at 24 because that's what it's trading right now. That's $4 of profit I would make on that stock trade. That $20 strike price call has $4 of intrinsic value. So $4 of real or intrinsic value. That dollar, that extra dollar, because I paid $5 minus 4 intrinsic, that $1 is time value. Anything that's not intrinsic value is time value. And options can have intrinsic value, time value, or both. And at expiration, an option is only worth its intrinsic value. So intrinsic value is very important for a beginner to understand because they'll know what their option is worth. Anytime they look at the price of the stock, look at the strike price of the option, do some simple math, and you'll know what your option's intrinsic value is. And if there is no intrinsic value, the premium is all time value.
Okay, so going back to your $24 stock example, you had also mentioned the 25 strike and the 30 strike. If that stock at expiration is not above 25 or 30, then those two options would be, I guess, out of the money at expiration. They'd have no intrinsic value because the stock is not through the strike, so the options would expire without any value. Is that right?
Yeah, the option would expire worthless, and that's where you would have your loss of the trade. Because the option you paid, like say the 30s, you paid $1 for the right to buy the stock at 30. If the stock was now at 28, you wouldn't exercise that right and buy the stock at 30. The option has no value; it expires worthless. You would lose that $1 that you paid.
All right. Well, very good. I think again, our theme for January is Options 101. Any other points you'd like to make with our listening audience, Bill?
Yeah, I would say as you learn options, be careful. Learn one or two strategies for bullish strategies, bearish strategies, and neutral strategies. Don't get overly concerned with getting into the advanced stuff right away. Learn one or two bullish, bearish, and neutral strategies. Try those out for a while. Practice those. Get to know those. Get comfortable with those before you move on to the more advanced stuff.
Good advice, Bill. And one thing I want to repeat, something you mentioned. Listeners, don't forget that we have My Path at optionseducation.org. It's basically an assessment, a 20-question assessment test that you fill out. And depending on how you do, we will send you either beginner, intermediate, or advanced lessons at your appropriate level. So, Bill, I want to thank you for taking the time today to share your expertise with us, and we look forward to seeing you on the road for the OIC.
It's my pleasure, Joe, and I hope we can do this again real soon.
Thanks, everybody, for joining us today on Strategy Spotlight.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Dr. Alan Ellman, President of the Blue Collar Investor Corp. Welcome, Alan.
No, thanks very much for the invitation.
Hey, thanks so much for joining us. How about if we start out by you telling our listeners about your history in the options business?
Sure, Joe. Well, it's a little bit unique compared to others in that options has been an asset for me in two regards. First of all, from a financial standpoint, I've been doing very well with options for about 25 years now. But also from a career vantage point, it actually was responsible for my changing careers because for most of my professional career, I was a dentist in New York and very content and happy with my practice. But what happened was in the early 1990s, I started teaching myself how to self-invest both with stocks and stock options. And that ultimately led to my getting invited to speak at some local investment clubs here in New York. And when I started doing my presentations, I was really amazed at the response of retail investors to stock options. So ultimately, that led to my writing my first book, Cashing In on Covered Calls, in 2006, which quickly became the #1 selling book on covered call writing. And since that time, I've published 5 more books, and I've been doing presentations across the United States now for the last several years. So I had to make a career decision at that point. Do I continue my dental practice, or do I move into educating retail investors regarding trading options? And, of course, I took the second approach. I'm very, very happy with it now. So, Joe, at this point in time, I have 6 books published, 5 of them on options. I've written 300 journal articles related to stock options, produced over 250 videos. I've also achieved a Series 65 investment advisor rep. But I choose to spend my time educating retail investors as to how to generate income with stock options as opposed to actually managing their portfolios. So I'm really, Joe, having the time of my life doing this options training, mainly geared to retail investors.
Boy, it really sounds like it, Alan. I mean, obviously you've got the fire in the belly, the passion. I mean, that's just quite a story, going from a New York dentist to here you are. Almost sounds like you're the everyman as the blue-collar investor. Really quite a story. And sounds like you're really doing very, very well with all this. Now, you talked about going back to the early 90s, and maybe that's when you started using options as an investor. Is that, when you really connected with the listed options product?
Well, I started out, I think, probably like most investors, buying and selling stock. And I always had like a little inclination to math, so I would always have a pen and paper in front of me and try to figure out various formulas. And, of course, my formula included both fundamental and technical analysis, along with what I call common sense principles like minimum trading volume, things along those lines. And I was actually doing very well buying and selling stock. I was beating the market by a little bit every year consistently. And here's where options came into my life. I recall it vividly. I was reading an article on self-directed IRAs. And in the article, it said that you could trade options in sheltered accounts. And that surprised me because at the time you would hear time and time again that options are risky. And of course, I embraced that and took it as the gospel, and correctly so. And so that kind of surprised me. Why would our government allow us to trade options, specifically covered call options, in sheltered accounts? So
hey, Alan? Let me, just so our listeners are clear, how do you define sheltered account?
A sheltered account is an account where you can generate profits and either defer or never pay taxes on those profits. So, if you have, again, I'm not a tax advisor, but, my understanding is that if you have a traditional IRA, then your taxes are deferred until you start withdrawing the money on retirement. And if you have a Roth IRA, you never have to pay taxes on those profits. So a strategy like covered call writing, where you buy a stock and sell an option against that stock, is going to be generating a monthly cash flow. So if you could trade those options in sheltered accounts, self-directed IRA accounts, then you will not have Uncle Sam in as your partner, while you're generating these monthly profits. So, that's one of that was what caught my attention, because I said, wait a second, I thought options were risky. So as I investigated this and I started learning more and more about covered call writing, to me it became very intuitive. I embraced it and I started educating myself, developing a system and a strategy. And that has become my main strategy in the stock portion of my portfolio, mainly because of the degree of success I've had with it. So that was all in the early 90s. I've been using that strategy now for about 25 years.
Well, that's awesome. It's a heck of a track record. And before I go on to a couple other questions, again, just for some listeners who may just be getting started in the option space, if you would clearly define what the covered call strategy is, maybe with an example or two.
Sure. Covered call writing is an option strategy, probably one of the most conservative option strategies, that involves two aspects. Number one, buying and selling stock. And number two, selling options against those shares. So let me give you a quick example. You buy a stock at $48, and now you own the shares, so you're in a covered or protected position. Once you own the shares, you can then sell the option. What you're doing is you're selling some unknown person, because everything's done online with the click of a computer, the right but not the obligation to buy your shares from you at a price that you determine, called the strike price, by a date that you determine, called the expiration date. Now, in return for undertaking this obligation, you're paid a cash premium that's dictated by the market. So, for example, you buy a stock at 48, you agree to sell it for 50, that option premium may be $1.50. On a one options contract, which consists of 100 underlying shares, that's $150 profit, initial profit, less some small trading commissions. So that's basically entering the trade. Now, at the end of the trade, at the end of the month, either those shares are going to be purchased from you if the price of the stock is higher than the strike price, or the option will expire worthless, but you'll still keep the $150 profit. So what you're doing is you're leveraging the shares that you already own to generate a monthly cash flow via the sale of listed stock options. It's a very, very simple strategy once you become educated and learn how to use it.
Talk to me about the potential, risks, disadvantages. Obviously, the advantage is to generate income. Talk a little bit more about your favorite strategy here.
Okay, Joe, let me give you some advantages and some disadvantages, because I think any strategy that's geared to generating higher than a risk-free return is going to have its pros and cons. Covered call writing has several positives, but let me highlight maybe the four main ones in my eyes anyway. First of all of the low-risk strategies that I have tried, this is the one where I've been able to generate the highest returns. Now, let me stop for a moment and highlight the word that I just used, low risk. I did not say no risk. We'll get to that in a moment. Second of the four reasons I'm going to give you is that you have an amazing amount of control regarding the outcome of these trades. The reason for that is that we're long the stock and we're short the option. We bought the stock and we sold the option. So we're in two positions. So there's a lot that we can do to mitigate losses if the trade should turn against us, or turn losses into gains, and also enhance gains. There are certain strategies that I've developed where you can actually get higher than a maximum return, as crazy as that sounds. So the control is the second of the four advantages I'm going to give you. The third, and this one is very important, you can compound your money in minutes, and here's what I mean by that. When you sell that option and you click that button on your computer, that cash is generated into your brokerage account instantaneously and available for you to use either that day or the next day, depending on the brokerage you're using. Now, you could take the profits from the sale of those options, use them to purchase new shares, and then immediately sell call options on those newly acquired shares, thereby compounding your money in minutes, a huge advantage to this strategy. And the final example I'm going to give, we've already alluded to, and that is the fact that our government considers this strategy safe enough to allow us to use it in self-directed or sheltered accounts. Now, on the other side of the fence, and there's always another side of the fence that we must be aware of before we decide whether or not we're going to embrace this strategy, and there are a couple of risks or disadvantages. So let me give you three of those, Joe. The first one basically is stating the obvious. If the price of the stock declines below your break-even, you could start losing money. Now let's go back to that example we discussed before. You buy a stock for $48, you sell the $50 call option and generate $1.50. Well, you have a debit of $48 on the purchase of the stock. You have a credit of $1.50 on the option side. Your break-even is $46.50. So if the price of the stock starts declining below $46.50, we could start losing money. Of course, that's where our exit strategies or position management techniques will kick in. Now, the second of these three risks or disadvantages is the one I would like your listeners to focus in on, because in my view, it's the biggest disadvantage to covered call writing. And that is your profit potential is limited by the strike price. Back to our example, Joe. Buy a stock for $48, agree to sell it for $50. A week later, let's say there's an FDA announcement about a drug approval that's manufactured by that company. The price of the stock goes to the moon. It's $60 in a week. Now, we've agreed to sell it for $50, and we want to get our hands on those additional 10 points, but we cannot because of our option obligation. However, we generated $150 on the sale of the option, $200 profit on the sale of the stock from $48 to $50, times 100. That's $350 profit on a cost basis of $4,800. Wow, you have a 7% 1 month return. So pat yourself on the back, say, nice trade, Alan, and move on to the next trade. Now, the third risk is what I would call assignment risk, which means we are obligating ourselves to sell our shares, and that could happen. The option holder, buyer, is in control of our shares. They may elect to buy our shares from us. We may not want to sell our shares. So that said, 99.9% of the time, Joe, our shares will not be sold until the day after expiration Friday, the third Friday of the month, 4 p.m. Eastern Time. Well, that means we could take action to avoid that from happening. And there are ways and techniques, part of our exit strategies, where we can avoid that from happening. Now, there are some rare exceptions to that where early assignment may take place, and that usually involves an ex-dividend date. This is all in my books and DVDs, how to manage your way through ex-dividend dates if you don't want your shares sold. And there are ways of managing that. Basically, the takeaway here is 99.9% of the time, you can avoid assignment if you know specifically what to do. Now, Joe, if I could just jump in and give one more thing here for your listeners, and that is, we talked about the pros and cons of covered call writing, but I want to highlight this very, very important point. Before you risk even 1 penny of your hard-earned money, there are 3 aspects to this strategy that must be mastered. And those are, number 1, selection of the most appropriate underlying stock. Number 2, selection of the most appropriate option. One size does not fit all with options, even though most covered call writers usually opt only for out-of-the-money strikes. And the third is, we've alluded to it before, position management. What do you do after you've entered the trade? The trade turns against you. It turns out much better if you want to avoid assignment. So this all must be planned out ahead of time. You must master all 3 aspects before even considering risking 1 penny of your hard-earned money.
I may be opening a can of worms here, but could you give me real quickly your approach to finding the best stock, finding the best strike, and then defining, your risk management parameters, rather briefly, but if we could just maybe offer our listeners a little more detail on those 3 critically important aspects. Okay, let me start with stock selection, and I'm just going to, basically give you an overview in deference to the time here. I use a 3-pronged approach to selecting stocks. One is fundamental analysis, where I look at earnings and revenue growth. The reason I like that is because these are the type of stocks that institutional investors like, and they represent 70% of the movement of the market regarding stocks and the success of stocks. So I want to be on their side. They like stocks that have earnings and revenue growth, and therefore so do I. Second, technical analysis. I use trend identifying and momentum identifying indicators, things like exponential moving average, MACD histogram. I don't want to throw too many fancy terms out here, but basically I like to take a look at the trend from a technical perspective. Is it going up, down, or sideways? I look at the momentum, and then I take a look at the volume to see if those momentum indicators are being confirmed by volume. Now, reading a price chart, in my view, is something that, as retail investors, we all need to know how to do. Again, it could be intimidating initially, but it's really, really simple. Once you've looked at a couple of dozen charts, you should be able to read a price chart in 3 seconds. And then the third prong of screening for the most appropriate stocks involves those common sense principles I alluded to before, which include things like minimum trading volume, asset allocation, avoiding earnings reports when it comes to covered call writing. Very, very important. One of the golden rules of the blue-collar methodology. And then we have our watch list. Now, moving on to strike selection. We have a watch list of quality, elite-performing stocks from the 3 perspectives that I alluded to, Joe. Now, what strike do we select? Well, let's say we're bullish on the market. Things are humming along fine. Globally, locally, the chart technicals are beautiful. We're bullish.
So what we do is we would opt for an out-of-the-money strike. Why? Because the out-of-the-money strike will give us an opportunity to generate two income streams. Quick example, gave it before. Buy a stock at 48, agree to sell it for 50, generate $1.50 on the option side. So you have an opportunity for $150 per contract on the option side, $200 per contract on the stock side, and the fact that we're bullish will lead us to that out-of-the-money strike. Now, on the other hand, let's say the market is bearish or volatile. We want that extra protection. Sell an in-the-money strike. Stock price 48. Instead of opting for the 50 out-of-the-money call, opt for the 45 in-the-money call. Now, that's going to generate $3 of intrinsic value, which is the amount that the strike price is lower than the current market value, 48 minus 45, plus another time value component to the option, maybe $1. So let's say we get a $4 premium on that. Well, now our break-even is no longer $46.50 as it was before. It's now $44. 48 purchase price minus the $4 premium. So we have additional downside protection selling the in-the-money strike. So what we could do here is we could tailor our strategy to current market conditions, to chart technicals, and even our own personal risk tolerance. Maybe you're the type of person that can't sleep at night if your portfolio drops 1%. So you might opt for only in-the-money strikes. One size does not fit all. So that's the second aspect, the strike price selection or option selection. The position management is something that is so important with any strategy you're using. And I actually wrote an entire book on this topic. But just to give you a quick example, Joe, I have something in my material called the 20%, 10% guideline. What it says is that if the price of the option drops to 20% of the original option sale price, you automatically buy back that option. So if you sold an option for $2 and it drops to 40 cents or less, you automatically buy it back in the first half of the contract. It drops to 10% in the second half of the contract. So you would buy it back at 20 cents or less in the second half of the contract. I have a whole set of reasons why I've selected these percentages, but basically it has kept me out of trouble for 2 decades now using these parameters. And whether you use my parameters or other parameters, the takeaway here is, Joe, that you must be prepared to act in a non-emotional manner based on sound fundamental, technical, and common sense principles if the trade turns against you or is even much better than you anticipated.
That's a good takeaway, Alan, and I'm glad we went there. You do a very nice job laying out the various disciplines that you've developed, and it's an awful lot for our listeners to chew on today, but I hope they're getting it because you're really doing a good job of explaining it crystal clear. Couple real quick things, because I know you speak to a lot of investors. Before we wrap up today, you've been in this space for an awful long time. As I said, you talk to a lot of investors. Is there a most common mistake that you see investors making in the marketplace?
Oh, yes. There are actually 2 major mistakes that retail investors tend to make. The first one is that they get so excited when they learn about these option selling strategies that they want to start right then before they master those 3 required skills. And like anything else, even though you might get the general gist of how a strategy works, there are certain nuances in there that will cause you to make mistakes and lose money while you're going through the learning process. So I'm always suggesting respectfully to investors to take your time to educate yourself. And that's why venues like the Options Industry Council are so important, specifically to retail investors, because they put out that education. And you can learn these 3 required skills, paper trade. It'll only take 3 or 4 months. And then you're good to go for years and decades. So the number one mistake is starting too soon before education and practicing. And the second one which is also very big, is that too many option sellers will select stocks and options based on the premium returns. So, my sweet spot for initial returns for a 1-month option is 2 to 4%. That's the time value component of the option initial return that I set my goal for. Now, in my mother's account, where I sell options on exchange-traded funds, I set those goals a little bit lower because I trade in her account a little more conservatively using ETFs, and the goal in her account is 1 to 2%. But you may be more or less aggressive than I am. But the returns you get will be based predominantly on the implied volatility of the underlying stock or ETF that you're using. So a lot of retail investors will tend to say, wow, I can get 8% in 1 month on that stock. I'm going with that stock A because of that high return. However, the downside is that there's a very high implied volatility component to that option, which means we're incurring a lot of risk. Now, that doesn't make sense to me because covered call writing is a conservative strategy geared to conservative investors. So what you're doing by using a high premium option is you're converting a low risk strategy into a high risk strategy. Doesn't make sense to me. So those are the two major mistakes, starting too soon and using option premium as a reason to use a specific underlying security or option. I say get your watch list of elite performers first before you even look at option premiums. Now that you have that elite list, now take a look at the option premiums and see which ones meet your goals, and those are the ones you go with.
More excellent information, Alan. I think we could probably chat for 2 or 3 days, but I think we're going to have to wrap it up. Before we do, any closing thoughts for the listeners?
Well, I think to summarize, Joe, I would say this. There is no one strategy that's right for every single investor. However, for those of your members who have even the slightest interest in options, and obviously this audience here does, or they wouldn't be listening to this interview, I think you owe it to yourself to educate yourself on the 3 required skills: stock selection, option selection, position management, and then paper trade. And then at that point, you'll be able to make a decision as to whether or not these option selling strategies are right for you. And let me just conclude with something I say all the time in my seminars and books, and that is education is power, and nobody cares more about your money than you do.
It's very true. And how can investors and our listeners, Alan, best get in touch with you?
My website is The Blue Collar Investor, THE, bluecollarinvestor.com. And you could reach me directly by email at Alan, ALAN, at thebluecollarinvestor.com. I do answer all of my emails.
Well, that's great, Alan. And for you listeners just getting started with options, do remember to check out OIC's 2 recent webinars on Options 101. They can be found by searching the Options Industry Council on YouTube. So, Alan, really, I think you've offered tremendous insights, a really disciplined approach to the listed options market, and I just want to thank you for your time and expertise today.
Thanks very much, Joe. Appreciate it.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, we'll start with tools and let you know about the FINRA broker check website, found at www.brokercheck.finra.org. FINRA stands for Financial Industry Regulatory Authority. FINRA oversees the people and firms that sell stocks, bonds, mutual funds, and other securities. Pull up the website and enter either your broker's name for employment history, certificates, licenses, as well as any regulatory actions, violations, or complaints you may want to know about. Or you can enter your broker's firm name to get similar information on the firm itself. The site is extremely comprehensive with 5 drop-down bars that cover all kinds of really practical information. Things like setting your financial goals, calculating cash flow, manage your debt, how your credit score impacts your financial future, and really much, much more. There are also tools, calculators, and a fund analyzer, as well as a hotline for immediate assistance. You could call them. The number is posted, and that number is 800-289-9999. There's also an email link for assistance. So remember, you can find all of this information at brokercheck.finra.org. Our resource today is the virtual trading platform. You'll find platforms at the OIC website, optionseducation.org, as well as many of the different exchange sites. These virtual platforms allow investors to test straightforward options positions, spread trades, complex multi-leg strategies, and more. Platforms are useful for both investors just starting out with options, but are also excellent tools for those more advanced traders who want to analyze far more complex strategies. We'll wrap up today's segment with our good reads. I'd like to offer 2 today. First, we'd like to suggest Options for Beginners and Beyond by William Olmsted, and also recommend Alan Ellman's Stock Investing for Students. Alan was a guest on today's show in the Profile and Perspective segment. In this month of the Options 101 theme at OIC, we think both these offerings can add to your foundation of options knowledge. Thanks for joining us today on today's Tools, Resources, and Good Reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back, we're going to do a quick review of options volume growth from 2000 to this year. Prior to 2000, the listed options industry never traded more than 500 million contracts in any given year. So that's from 1973 to 2000, we never traded 500 million contracts. Boy, have things changed. Between the year 2000 and 2005, annual options volume grew threefold, from 500 million contracts to about $1.5 billion. Between 2005 and 2009, the industry went from 1.5 billion contracts to over 3.5 billion traded that year. And since 2011, each year, the industry has traded over 4 billion contracts annually, averaging between 16 and 17 million contracts traded each and every trading day. Reasons for the stellar growth include electronic access to the marketplace, which started in 2000 with the formation of the ISE. Improved trading platforms, ETF growth, and options on ETFs have also been a contributing factor to this stellar growth. Another factor is the education offered on the listed options product by the industry as a whole, including brokerage firms and, of course, the Options Industry Council. In the end, versatility of listed options, those financial tools that can help you protect your value of the portfolio as well as generate additional income, may be why options volume continues to grow. Thanks for joining us on today's Looking Back.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.